Hello and welcome to Border Crossing, essential information and opportunities for international businesses with Chip Hobecker. These podcasts are designed to help you get a better understanding of some of the most important current issues and problems that affect businesses. Chip will examine the key points, help you to see the advantages and disadvantages, and provide you with any help sheets and support that you need. And just so you know, Chip heads up both the consulting division and the turnaround and restructuring practice for the firm Raymond in the US. He has served as a court-appointed receiver, a chief restructuring officer, and as a fiduciary in international, federal and state proceedings in the US. He's also a board member for the National Association of Federal Equity Receivers, where he heads up the International Committee, and he's a fellow of Insol International. If you want to get in touch with Chip, he can be contacted via the Raymond's website or on LinkedIn. We hope you enjoy this podcast. So Chip, how are you doing? You all right?
Good morning, Becca. I am doing fantastic. How about yourself?
Oh, yeah, well, apart from the electricity going at home and having to rush to someone else's house. But I left everybody else to deal with it. And so I'm quite enjoying it, actually. It's easier. But it's great to see you. And I've been really looking forward to this session because obviously I'm a business owner myself and cash flow is one of my sort of challenge areas. So I'm really looking forward to see what you say about it and to learn something from you as well. So, I mean, we're going to talk about cash flow projections and how to improve your positions. So I'm going to hand over to you, let you talk about it, and I shall ask questions and take notes so that I learn too.
Great. Thanks, Becca. So what we're going to do today is I'm going to talk just for a second about the difference between the traditional monthly accounting reporting that you might do yourself or have a CPA or a chartered accountant do versus the cash flow projections, the uses of both, and they're both valuable. But I'm going to chat about that for a minute. Then I'm going to hop right into an example of what a weekly cash flow statement would look like, how you might organize it, some tips and best practices that I would suggest to make them both easy and practical. And then once we talk through a little bit about how they work, then talk about how we actually use them to manage and how they might guide decisions, identify problems, some of the solutions for those problems. All with a caveat, this is going to be a real simple cash flow projection from a fictional company called Bob's Pub. You may have a more complicated projection that needs to be put in place. It may have, we see them with different revenue streams and different products and different uses. You might have lines of credit that you've got to factor in as far as how receivables and inventory move around. There's all sorts of advanced things you can do. This is really simply to sort of get the juices flowing around the idea of what to do with. So
yeah, no, it's great. And would this apply to any type of organization, whether it was service industry like me, or I mean, obviously this one's a hospitality company, but is it the same tactics for everybody?
It's the exact same practice for everybody. And that's probably a good segue into why these things are important. And firstly, to say they're vastly underused. Very few people actually use a cash flow projection to manage their business. We're very familiar with the monthly financial statement or the annual financial statement. Mm-hmm. Sometimes we're really, really disciplined, and 5 days after month end, we have the numbers. Other times, 6 months after year end, we have the numbers. Either way, those are what we call historical financial statements, and they tell us what happened.
Yeah.
And if they're prepared by a certified accountant or a chartered accountant, they're probably prepared in accordance with GAAP if you're in the U.S. or IFRS if you're in other places. And they've been boilerplated so that they're all apples to apples. So anybody who looks at those sorts of historical financial statements can rely on them and can compare them to other similar financial statements because they're prepared under the same methodology. And it's all very valuable and very good. But it really tells you what happened a while ago. And so I'll give you a great example. If it was December of 2019 and you got your monthly or your annual financials in March of 2020, how useful do you think December or 2019's financial statements were for managing the business during the slight disruption that happened in 2020?
Yeah, I can see that.
not very, right? Things change.
And just a bit.
Yeah, and what we found since then is things haven't stopped changing, right? The world is changing at an ever increasing pace, and you can't be 6 months behind or even a month behind oftentimes without finding yourself potentially in trouble. And so what these weekly cash flow projections do is they start off with what cash you have today, and we project what cash we think is going to come in the next 7 days, what needs of cash we have, and we compare those. And if we have cash in the bank today and we have more cash coming in than we're going to use in the next week, then our cash in the bank will go up. If we're going to use more cash than we're going to get, the cash in the bank will go down. Sooner or later, if we keep using more cash than we get, the bank cash will run out.
Yeah.
And therein lies the ultimate problem. And so what this cash flow projection does is it allows us to take a look out, and 13 weeks is what we recommend as the short-term cash flow projection. Everybody should be looking essentially quarter by quarter, saying, what do we think is going to happen? We do it weekly because you can run out of cash, in the wrong weeks. If you have payroll one week and you don't get...
No, that's absolutely true, because I've seen that in my own business. And I find this is the most stressful bit, is sort of trying to work out, because you've got all sorts of different things going out and you've got to pay your people and, what's coming in. And I find it quite hard, actually, to keep tabs of everything. Plus, you're trying to run the business.
Well, you are.
So you're looking everywhere.
Yeah, and what you'll find when we go through this is that it's fairly easy to identify when you're going to pay things. You know when the monthly electric bill is, you know when payroll is, you know when insurance payments are due and tax payments are due and these different things. And so there's always some surprises that pop in, so you want to have something baked in for those surprises. But by and large, the easier part is saying, when do we have to pay things? We're very seldom surprised by not having to pay something when it was due. What is tougher is to prognosticate when the cash will come in. And so we'll talk about that as we look at these things. But that's probably a good segue to just hop right into what one of these looks like a second. So, yeah, and so for this example, we said we're going to start at the beginning of the third quarter. So July 1st of 2023, we'll start our weekly cash flow statement. And so in this cell, you'll see we just put a date in. Here we have a formula saying equals that cell plus 7. And so Excel will simply kick out a week all the way along for you. So it's a very simple formula. We try not to type anything if we can help it. As we work our way through in this example, it's important to recognize we're talking about a cash business here as opposed to a non-cash business where you have receivables. So, very seldom do you go pick up your pizza and put it on credit, right? We're going to come back and pay the restaurant later. You may pay a credit card, you may do that, whatnot. But so for this example, the when the cash comes in is with the services provided. So there's some matching there. In a manufacturing company where they maybe get paid 60 days later, what we'd be looking at here is the sales 60 days ago and how much cash would come in. So a real important thing to understand, and we're not going to try to delve into that too terribly much other than to say that it's important to recognize this is not income, as in when a sale is made and you ship something off to China or Australia or something, and the cash comes later. In the GAAP financial statement type, you'd show the income when the sale is made. But that's not this. This is saying, okay, when are we actually going to get paid? And so that's the most important thing here, is trying to have a good understanding of when we're going to get paid. And what I would do to start is I would simply take some period of time, maybe it's last year, last quarter, last month, and I would take a period of time, not just a week, it's got to be more than that, probably at least the last quarter is best practice. You have 13 weeks, and I would take the total that you got in food, total you got in pizza, total liquor sales, and I just divide it, if it's by 13 weeks, I divide it by 13 weeks and say, okay, we're going to start off and we're going to say as our base point that we're going to have the same performance as we did historically. Now, I would then sit back and say, okay, is there anything that's changed that I know about offhand? Did we just bring in a new line of liquor that costs more? Did we just put in a new pizza oven? Did we just add Uber Eats to the delivery or something that might impact things? So you do think through that, but if nothing's really changed and you think performance is going to be just kind of the same, then you say, okay, are we going to go up or down each week? And so here, we're anticipating about a 3% growth rate per week. So there's just a formula here that takes the $30,000 times 1.03, and we sort of work our way through. In this case, we're anticipating a 3% growth rate, just perpetually during this 13 weeks.
Right. And have you taken that growth rate from what happens in that other quarter that you're looking at, or in the last quarter?
Yeah. So we're saying, okay, we're going to try to improve things. We are working to manage the business.
Yeah.
And so we expect to have some change. We're either advertising, we're doing some special deals. There's something that we're doing to try to drive the business. And you may also need to factor in, what's going to happen around holidays. Is there a holiday that's in this period, like in the U.S., July 4th? July 4th is in the week of July 1st.
Yeah.
And so what happens to your restaurant during July 4th? Do you sell a whole bunch of stuff because nobody wants to cook? Or do you not sell anything because everyone's home barbecuing? And you'll know that from years past. You'll know that from trends and whatnot. But you'll think about those seasonal things that might impact it. And so, there's a lot of considerations. And this is probably where it's time for a plug to try to bring in a professional to help you with some of this.
Yeah, I was just thinking that spreadsheets aren't my strong point.
Well, it's the spreadsheet point, but it's also the really helping you think through the business. You're essential because you have some knowledge the professional won't have, but the professional is essential because they'll have done this 1,000 times and it's your first time.
Yeah.
And so you sort of need both. And there's great professionals. If you're in the U.S., you can give us a call at Raymond. If you're in the United Kingdom, in London, Menzies or Beavers and Struthers in Manchester, Manjudd in Sydney, wherever. There's firms everywhere that can help you with this sort of thing. Certainly, if you're having trouble finding someone that you feel confident in, give me a buzz. I can hook you up anywhere. Happy to help. But you do need to have that. It's not a forever engagement, but it's something at least to help set up the model and think through things for kind of the first year. After the first year, you've probably got it in good shape.
Yeah, you see, I'd find that really helpful because I'm a marketeer. I'm not. This bit for me is tedious, to be honest. Yeah. I find it really difficult, and so having that kind of help for me is really important because otherwise I'll never get around to it because it's too difficult to think through as well.
And honestly, it doesn't take too terribly long. I mean, you're talking a day and a half of someone from stem to stern helping you think through these things.
Well, I suppose because they're used to doing it, isn't it? It's what you're paying them for. It's that knowledge, isn't it?
Yeah. And that maybe takes me to some best practices. The first thing to do is to make this thing look and feel like your normal income statement. Whatever your revenue numbers are here, whether it's, tire sales or advertising revenue, or that should be here. So we start with your financial statement. So we have, employee perks, when you do this, you follow your financial statement, you get these net cash receipts by weeks, how much money's coming in. Then you have your cost of the products. And again, these can be formulas. They can be all sorts of things. You have your operating expenses, which is going to, again, look just like your financial statement. And now you get down to some things that don't look like your financial statements. You might have some other non-routine disbursements. So maybe you have a parent company you've got to pay some corporate salaries to. Maybe you've got some rent payments that come up, periodic tax and advisory fees, emergency repairs and maintenance, and then balance sheet activities. So these are things that aren't part of an income statement, but you may have some payables. You may have some debt you have to pay. So maybe some judgment creditors, a PACA claim. There's different things, property taxes that come out periodically, personal property taxes. And so when you work your way all the way through this, you take what you have to pay out compared to what you have to pay in, and each week it gives you a net. So in this first week, we're paying out $70,000 more than we're collecting. Now, we start off with $125,000 because we've banked some money knowing we have to pay these things.
Yeah.
So we have $54,000 left. In week 2, we actually increase cash $87,000. So we start off with a 54, gets us up to 63. You see how it works, as you go along.
Yeah.
But where I'm going to take you to here is where we know here in week 6 or 7, we have a bunch of unusual expenses or payments we have to make.
Can I just come back to, I'm interested in you banking that money, because that is another area where I have in the past been caught out, because you forget this is coming in and you suddenly get hit by a big tax bill or a VAT bill and you're suddenly like, oh no, I've forgotten all about that. Where am I going to get the money from? And you've only got like a month to pull it together.
Well, and it's a perfect example, because that's what happens here in this column. We get over here a few weeks, we have a bunch of things that are due here and here, and suddenly we're actually short cash.
Yeah.
So we thought we banked enough money, but we're short $10,000. Now we're back on track the following week, but this week we're in trouble. And it's for exactly what you just mentioned. If we didn't have this cash flow projection, we would be caught up short. We'd suddenly say, whoa, we've got some things we have to pay, and I can't write a check for something because it's going to bounce. Sooner or later, checks require money, it turns out. Yeah, I know. It's such a bother.
It really is.
So this is where the management comes. This is where, when you have done this projection, you remember the things you're supposed to remember. You have a third-party professional who pokes you a little bit and says, hey, when is your cash due? When is insurance due? When do you pay retirement funds? All the different things that are easy to forget, those things that only get paid once in a while. They'll help you remember these things. And, you throw something out there on the calendar, and you are on the calendar of the cash flow projection. And now all right, I have to figure out how I'm going to make up this deficit down the road. Now, $10,000 in a small business, maybe the owner just writes the check, right? Maybe they've just got a personal check. Maybe you sit down and say, okay, is there something I can do where I can drive a little extra business during some of these months? I send the food truck out to the manufacturing place, or the king's coronation's going on. So we make sure that we have the pizza of the month deal, or I don't know, any number of things that you can do potentially to drive revenue or collections. And that's the other piece here about driving collections, right? If you know you're going to be short, then can you drive some collections earlier? Do you offer customers a discount if they pay you in advance, for example? Sometimes you give them a 5% off if they'll pay you 30 days early. You reach out and maybe you bundle something and say, listen, if you'll pay me 90 days of fees, I'll give you 120 days of service, or any number of ways that you can do it to try to drive collections faster. Sometimes it's just getting on the phone and calling somebody, right? It's just calling that customer and saying, hey man, I got payroll coming up. Help me out here.
Can I ask you a question about the bundling? Because it's something I've thought about and I've discussed with other people, and there seems to be a very split view on it, that you sort of train your clients to then expect discounts.
So firstly, you don't have to do it with everybody, right? If you need $10,000, you don't have to go out to all of your clients. You can just pick or choose. Either maybe someone's a very good client, and so, there's almost a little spiff for being a good client, or maybe someone is a decent client, but they could do more business. And so maybe your offer is, listen, if right now you split your marketing between 3 places. If you'll just give it all to me, we'll do something. And so you got to make an economic decision there, and you don't want to hamstring yourself permanently for a short-term cash need. But that is a strategy. It's just one of many. And again, you can think through what you want to offer. Again, if you just need, in this situation, if you just need $10,000, it's not an incredible amount. Now, if that bogey's $1 million, yeah. Now you've got some different things to think about.
Now I'm looking for a whole new career.
Well, maybe not. Maybe that's going to be, you may have a seasonal business, right? Maybe a ski resort, or a restaurant. Yes. Maybe Bob's Tavern is up in the ski mountain, and it's only busy during part of the time, and it's actually very profitable over the course of the year. But when you do your cash flow, you recognize that during parts of the year, you're up against it, and other parts of the year you're flush. And so part of the cash flow management is not to blow through all of that cash when you're flush, right? It's to hold on to it. But if you do have some of these times, that's why lines of credit exist, right? So you might have a line of credit where you go to the bank and say, hey, we're seasonal and we need some help here. And so, that's one way to do it. Equities and other, managing the cash flow if there's bigger issues. But I suppose the real point here is that, we use the example of a ski resort as a seasonal business having, cash ups and downs. And it's all very easy to understand when you think about a ski resort. But the reality is it is everybody. I mean, almost every business has better and worse times of the year for cash. And so, this process of managing it just becomes extraordinarily critical. And again, if you do this exercise and you find out that you've got some periods of time that are super tight cash-wise and too tight, you're out of ideas, none of your ideas are working, again, that's where you call the professionals and you say, hey, Chip, help me out. Can you Do you have any ideas here? Are there any thoughts that you might have? And there's a lot of things. Maybe it's a good business. You just need some more capital. Maybe you bring in a junior partner, or a senior partner, or, those sorts of things.
Yeah, and I guess because you've seen, as a professional, you've seen very similar situations, you can dip back into your experience and think, well, we did this in this instance, or this worked for this different company. And
yeah, you do. And I'll tell you, if you're a company that does these cash flow projections, you will not get caught surprised very often, and you'll have weeks or months to deal with a problem. Where it becomes very difficult is it's Friday and payroll's today, and you just realize you don't have any money.
Yeah.
Now our options are a lot more limited, and it's a lot more urgent, and it's everything is more expensive, everything is tough. And so by properly managing these things, you can take a look, but you can also see what the end game is, because while you do have a lot of tools to manage cash on the short term, if you do this for a year, I don't care what your financial statements say. If at the end of the year you started with $125,000 of cash and you need $1 million, and you're not going to have $1,125,000 at the end of the year in cash, you didn't break even. You may have a bunch of accrual based income. Maybe you've got depreciation expense. You do all sorts of things with the financials, but ultimately cash still becomes king. And this cash flow statement should show that at the end of the year, you're going to make that cash. Now, where there's a few caveats is if you have distributions to owners or something that's decreasing cash, I'd add those things back. But if you just look at the cash balance, if you as the owner, if you're working your tail off for this small business, you're not taking out any cash, you're trying to make ends meet, your cash isn't going up. Now it's time to say, okay, what do we do with this? But that's all about the opportunity to manage using this management tool. I'll show you another thing that you can do. So this is the cash flow projection piece. And we've especially the first time we do this, we've made a bunch of guesses, right? We have guessed what we thought we'd do. You can very easily take a look at your forecast, and this is just the revenue piece. Pop up your forecast, and then at the end of the first 4 weeks, say, okay, what was my actual? Well, in this case, we forecasted 140. We made 173. We're good on the revenue side for $31,000. That's a good result. And so you might go back in and true up your forecast a little bit if you think that's going to continue on. Maybe we were too conservative in our guessing, or maybe this is going to show that we were too aggressive in our guessing. But either way, every month we should do this analysis and say, okay, how was our projection? Again, there's a myriad of ways this goes. Most people have a bent where they're either wrong conservatively all the time, or they're wrong liberally all of the time.
Jen. And you as the professional need to work that out pretty sharpish, don't you?
Yeah, but this truing it up every 30 days allows you to start understanding your personal trends. What are your habits? How do you look at it? And then again, your professional can start modifying the model based on those trends.
Yeah, I was going to say, because once you start to see the variance, there's a regular variance, you can start to project that forward into the guesses that you've made going ahead for the rest of the year, can't you?
You can. And there's some reality here too. So this particular model goes on, I think it's a 3-year model.
Right.
So it goes on for 3 years. And, if you look at the end of the first year, you can compare that to your historical financial statements. And if you're projecting, that you're going to make 10 times as much money as you've ever made in the past, that's a clue your projections are missing something, or they're too aggressive. Similarly, if they're way, way less, you have this. So there's some reality checks that your professional can make. You can make them too. But what I try to do is I try to firstly do the best we can to start with. I do try to err on the conservative side, right? I'd rather have more money than less money.
Yeah, I do too.
At the end of it. And then I would every month true it up and say, how am I doing? Did I miss something? Did I miss something that's a one-time thing, right? Where there's, again, King's coronation, drove a lot of business. Lots of pizza got bought that day. Well, that's not recurring, probably, very often. Or is it something that's a recurring thing where, okay, every Friday the subway workers are striking this year, and so they're buying a bunch of pizza for everybody. Those sorts of things you can start to figure in. But as you actually use these cash flows, as you true them up every 30 days, as you monitor what goes on, you'll start to refine them. You'll start to miss fewer things. You'll start to have better projections, and it'll start to be more automatic. You personally will be less needed. You can delegate it down to a team member or have the professional update it once a month. But it is a good thing to be accountable with. It is a good management tool, and you can model these things out to include your lines of credit. You can model these things out to include income tax projections, state, local tax projections. If you have international business, you can do foreign currency exchange rate type things, and you can build into the model ranges as well. I've seen some like foreign currency exchange rates is a great one where you say, okay, we're not sure exactly what the exchange rate is going to be in 90 days. So let's build out a range. Let's look at the 90-day low and high from the last 90 days and say, okay, what is that going to do to us?
Oh, that's clever. Yeah. So you can predict if it's bad, then this is what we've got to think. And if it's good, then we're in a...
Yeah. And you can do the same thing here. So for example, another thing that I might do early on in our cash flow projection here is I might actually have 3 of these weekly cash flow tabs. The what if everything goes to hell in a handbasket tab, this tab, which is I'm going to call the medium tab, and the holy smokes, do we have enough people to serve everybody tab. So we can see what it looks like if you have a really bad time, what we think the time's going to be, or we blow the top off the thing. And so again, you can play around a lot of different ways, but the very critical thing is get started. And whatever you do, true it up after the first 30 days and see how you've done.
Yeah.
There's not a right or wrong. No one's in trouble. If you've gotten it all wrong, learn from those first 30 days and try to make the next 30 days a little bit better. And you just keep on going along. If you need to use your professional to keep you accountable, that's an easy thing to do. They'll be happy to help. But this tool should be used by every single business. The ones that don't use these tools and get in trouble are the ones that I deal with on the insolvency side, where again, it's Friday, there's no money for payroll, taxes are due, and they've missed payments with the bank, and all these different things go on, and they're not quite sure what happened. And usually it's because they hit a market right and they just coined money for a little while. They never had to worry about it because they always had money. But we know that businesses go through life cycles, right? And there's sooner or later every business goes through what I'm going to call a mature life cycle point where they stop coining money and now they've got to manage it. And if they were smart when they coined the money, they kept a bunch of it. And they're flush with cash. But on the other hand, then you'd have the estate planning people and the tax planning people who would tell me they shouldn't keep that much tax in the business. So there's a yin and a yang to everything. But you do want to make sure you know where your cash situation is going and what that long term looks like, because this will lead you down a lot of decision trees. If you're thinking about expanding, you can build in what does that expansion look like. The problem with expanding, let's just say you were going to add 5 people.
Yeah,
I can tell you when payroll's coming.
Yeah.
I can tell you when the cost is going to come. You're going to have to guess if you've got the work for those 5 people day one, or if you've got all the payroll and none of the work for a couple of months, and you're doing it as an investment to try to keep things moving.
Yeah, and that's exactly what I've had. I've just launched a new business, and actually tracking the sort of outgoings related to that has been a challenge as well. And sort of trying to make sure that you're managing the business you're in, plus growing a big part of it as well, and the impact that has on your cash flow. I can see how that would really impact and how that would help to, if I'd had something like this in place 12 months ago, that would have really helped with it, actually.
Well, and I'll tell you, it helps from the management standpoint. It also helps tremendously when you're dealing with the outside world. If you're trying to get credit from a new supplier, you're trying to go to the bank and get a line of credit or get an operating loan, you're going to partners to potentially get new investment. If you can show that you've got this cash flow projection, that you manage your business, you have a leg up to start with. If you can then show them, okay, I've been doing it for the last 2 years. Every 4 weeks, I true it up. Let me show you how accurate we are right now. That gives them a lot of confidence in the cash flow projections you're going to show them. And the more confidence that you can project as far as, one, you're actually managing things, and two, the results of your managing things have been promising. You're actually able to manage the ebbs and flows in cash. Not that you don't ever have challenges, but that when you have those challenges, you can deal with it. There's no bank, there's no creditor, there's no vendor who thinks you're never going to have a challenge. What they're really interested in is when those moments come along, what happens? Do you have a plan? Do you typically manage these things?
Yeah. And the thing that I think a lot of people who are entrepreneurs or have their own business, and I know from talking to others, is you're always worried. You're constantly worrying about where the money's coming from and things. And to have that sort of set out for you, it takes all that worry away, doesn't it? And you know where you are.
Well, or at least you know when you have to be worried.
Yeah. Whether it's a reality worry. That's the thing. I think a lot of people just worry because it's their business rather than actually basis for it.
But I mean, this becomes all sorts of projections for the business owner too, right? How much cash can I take out of the business? How much cash over the couple of years can I take out? Can I build up retirement? Can I get a second house? Can I get that yacht down in the Caymans? All the different things that people like you have to worry about. This.
Oh yeah, the yacht in the Caymans. That's me. Yeah.
Yeah, but even planning for college for the kids, planning for weddings for the kids, things for grandbabies. I mean, all those sorts of things become easier to see and project a little bit. And then again, you can start to think about, okay, do I need to manage it? Am I happy with these results? Because there's a world where you have enough cash, right? And so it's acceptable, but is it ideal? Because sometimes good is the enemy of great, right? You don't have to worry, but because you don't have to worry, you're also not hustling like you might.
Yes, I get that. Yeah.
And so if you build in some goals here, I mean, maybe you have another row where you say, okay, this is the net cash flow, the beginning and the ending. Here's my target. I want to have X dollars in reserve, and you can build a dashboard which is either green or red all the time, and you have a goal towards making it green all the time. And then your next one is, okay, now I've got my dashboard. Now I want to be able to coin some money afterwards and see where we get to.
That is very appealing. Actually, I really like the idea of the sort of setting yourself targets and then building your cash flow to help you achieve them.
Yep.
Because, and I suppose really it's like you do your home finances, isn't it?
It is.
I think we often take more care with our home finances. Yeah. We think about a business finance in a completely different way, but actually you've got to plan for things in the future in the same way, haven't you?
Yeah, for sure. I mean, this is just that tool that lets you be prospective. The historical stuff is all good and it's all important to understand, and all of your external parties will be interested in that too. But this cash flow projection, this is the thing. If you do ever get in trouble, this is the first thing that your insolvency professionals are going to do, because it tells them how much trouble you're in, and that tells them when they need to get cash, and what all the news is. So hopefully this has been helpful, Becca. Hopefully it's been helpful to you. Hopefully it's something that users can use.
Yeah, definitely.
I think we'll probably have a couple of more sessions that we do on some more advanced versions, but I hope this is provided a good vision for what it looks like, how easy it is to set up, and some of the things you can do with it. Yeah,
I know. It's been really, really interesting. So if people wanted to get in touch with you, Chip, where's the best place for them to find you?
So they can get me at the Raymond website, REHMANN.com. They can get me on LinkedIn. Any of those places are easy to get to, and I'm on them all the time.
That's brilliant. Well, thanks so much, Chip. That's been hugely helpful. I've got a lot of homework to go and do now. So I'm going to go get started. Right.
Fantastic.
Anyway, thanks for your time, Chip.
Thanks, Becca.
Thank you for joining Chip for this podcast. If you want to get in touch with Chip or any of his guests, please contact him through the Raymond website, www.raymond.com, or on LinkedIn. All views expressed in this podcast are individual opinions and do not constitute professional advice. Thank you.